Welcome back to Biz Asia America. It was a remarkable year for developed markets. They shrugged off the Eurozone crisis and they virtually ignored the budget battle in the U.S. Global markets are now hovering at a 6-year high as the year comes to a close. Now, Wall Street went from record to record. The S&P 500 rocking and rolling. It's poised for a 29% increase this year. That is its biggest annual gain since 1997. And where Wall Street goes, so does Japan's Nikkei 225. But this year, it got an extra boost from Prime Minister Shinzo Abe's radical economic policies. It gained a whopping 57% for the year. Now, to talk more about how the developed markets rounded out the year, we are joined tonight by Jim Rogers. He's in Singapore, and he should know a thing or two about what drove the markets, as he's the author of numerous books on both developed and emerging markets. He's also the chairman of Rogers Holdings. Thank you for joining us tonight. Jim, just a wild ride for Japan in the markets. Tell us, what really was the driver of the markets, this amazing performance, the best since 1972?
Well, you're exactly right. It did go up a staggering amount. But remember, the currency collapsed. The currency was down 30% or something in 2013. So while people think they made money, if you adjust for the currency collapse, you didn't make quite so much. You certainly made a lot of money. But what's going on in Japan is the Prime Minister has said he will print, and his word is, unlimited amounts of money in order to get the things going again. Boy, he did get things going for stockbrokers and for stock market investors.
Okay, and what sectors really benefited from this monetary policy?
Oh, everything. You know, when the stock market goes up over 50%, it's hard to find something that didn't go up. And if you can find something that didn't go up, you probably should think about buying it because it's going to go up. Mr. Abe has said he's going to do whatever he has to. Remember, the Japanese stock market is still down 65 or 70% from its all-time high. There's an enormous scope for more increases in the Japanese stock market. I happen to own Japanese stocks, and I'm not selling at all right now because I see what he's doing. It's not good for Japan. Printing money is not good. It's never been good in the long run, but in the short term, it certainly does move stock markets.
When you talk about short term, I mean, how long are you talking? Do you think 2014 is going to be still a bull market for the Japanese markets?
Yes, yes, yes. I haven't sold anything. If I come across something, I will probably buy more. You have to also remember that this is the first time in recorded history that every central bank, major central bank in the world, is printing huge amounts of money. America, England, Europe, everybody is printing a lot of money. So we have worldwide a huge artificial sea of liquidity. I mean, look out the window. You'll probably see the ocean rising, rising, rising because all this liquidity is going on out there from every central bank. This is not good for the world. It's going to end very, very badly when it ends.
Okay, all right, all right, when it ends. But I guess the question is right now, it's not a rally that's driven by fundamentals. It's a rally that's driven by countries printing money. You said this could end very badly. How could it end badly, and who would it end most badly for, if we can say that?
Well, when you look out the window and you see the ocean of liquidity going down, when you see all this money drying up, which everybody has been printing, we're going to have a big collapse in stock markets around the world. And all stock markets will go down. The U.S. may go down the most because right now the U.S. is at an all-time high. As I just said, Japan is 70% below its all-time high. China is 60 or 70% below its all-time high. So the people who will suffer the most are the ones who are up the most. It's pretty simple arithmetic.
Okay, and then speaking of the U.S. markets...
But it's not going to happen anytime soon.
Okay, so well, yeah, what is your time frame for this? Because we saw that the Fed recently announced that they'd be tapering their program, buying $75 billion in bonds a month versus 85, so just a minor tapering there, keeping interest rates low for a long time. I mean, when do you think that we're going to see a change in monetary policy? And what's going to be the trigger?
Well, what will probably happen is the Fed will continue gradually to cut back. Eventually, maybe in 3 months, 6 months, I don't know, I'm no good at market timing, the markets will go down because people will get scared. But then the Federal Reserve, because it's run by bureaucrats and academics, will get scared themselves and they'll start loosening up again and they'll start printing more money. So this will turn into a bubble in 2014, 2015. I don't know when. I assure you, when pain starts coming again, they are scared. They're bureaucrats. They don't know how markets work, and they're going to print more, which means all markets around the world will go higher and higher. I would suspect by 2015, 2016, the rest of the world is going to say, wait a minute, this is insane. We're not going to take this garbage anymore. We don't want your paper money anymore that you keep printing. And then we'll have a serious problem. And the next time the problem comes, it's going to be much worse than 2008 because the debt is so much higher. So you should be worried, and you should be scared, and you should be prepared.
Not a good note to end the year on, Jim, but thank you so much for your thoughts. That's Jim Rogers, author of Street Smarts, Adventures on the Road and in the Markets, and chairman of Rogers Holdings. That's the word on developed markets in 2013. We're now going to head to Phil in D.C. to find out about how the emerging markets performed. Phil?
All right, Karina, thank you. You're awfully nice to Jim. You know, the IMF and the World Bank are downplaying their expectations for emerging markets for 2014, and one that everyone is watching is China. Forecasts put growth at 7.3% for next year, down a little from this year compared to 2010. Mexico, one of Latin America's rising stars, is expected to slow down as well. Investors will be waiting to see what impact these new reforms and changes to the country's energy market is going to have. And then there's Turkey. The country is expected to go 3.5%, but the political climate is not good, and it's giving investors perhaps a little pause for what's going to happen in Mexico, Turkey, and other developing markets. We're joined by Jim Rogers again from Singapore. And Jim, first of all, good to see you. Hope you're doing well. Let me start with asking you, what the heck happened to emerging markets this year?
Well, what happened to emerging markets this year was the Federal Reserve and the major central banks were printing a lot of money, so money went into the big markets, Japan, America, Europe. That's where people wanted to put the money because that's where the money was being printed. At the same time, since interest rates started going higher, many emerging markets, which have big trade deficits, have to finance those deficits by borrowing money. India, Indonesia, Turkey, these countries suddenly realize, oh my gosh, we borrow a lot of money, interest rates are going higher, so things are not so good anymore. And the money was going to the Japan and US and places where the money was being printed.
You've gone on the record saying how much you dislike the printing of the money, how much you like the borrowing of money, and how bad it is longer term for these economies. That said, give me your surprise predictions for 2014. Where are we going to see surprises at in the world?
Well, that's an extremely good question. And if I knew that, I'd be rich. What you should do is watch CCTV, you know, and you'll probably find, yeah, you'll probably watch CCTV. They know everything. They'll report for you. I'm not sure. I think one surprise will be China. The Chinese stock market will probably do better. At least some parts of the Chinese stock market will do better because, you know, at the recent conference in November in Beijing, they said we're going to emphasize these sectors of the economy. Those sectors are going to do very, very well. I don't know if the Chinese stock market overall will do very well, Phil, but those parts, the parts where they're going to put money, I'm putting money there. I've learned over the years that if a government puts a lot of money into a sector, I should put money there too.
All right, we're going to get to China in a bit, but I have to ask you a personal question. You've been a big fan of gold. It's no secret. The whole world knows that if you've been watching CCTV or any other major network. It hasn't been a good year for gold. In fact, it hasn't been really a good year for commodities at all. And it's awkward, right? Because of the printing of money, you would think that would be good for commodities, but it actually has kind of been a little bit of the opposite. What happened?
Well, what happened with gold, and I haven't been buying gold for a while. I do own it, and I haven't sold any gold, although I have hedged some. Gold went up 12 years in a row, which is very strange, so the correction is an anomaly as well. But more important, India, which has been the largest buyer of gold for decades, has suddenly tried to make its people stop buying gold. They've cut back enormously. When you have the largest buyer cut back, if anything, it's going to cause a problem. I'm not buying gold now. I suspect there's going to be a better chance to buy gold in 2014, 2015, sometimes in the future. But I'm not selling any gold because longer term, I mean, gold could go under $1,000 US per ounce, but longer term, don't sell your gold. I'll tell you, all these governments keep printing money, as you wisely point out, and then eventually it's going to have an enormous effect on real assets.
All right. Jim, stay right there. I want to share with our audience something on this local government debt story out of China, and then I'm going to get your take on it. Local government debt in China is a problem. New report out of Beijing shows that the government there owes nearly $3 trillion. Central government debt plus local debt plus all the other financial debt now make up more than half of China's GDP. It's not a big deal for most economies, but there are some serious concerns that the local debt is piling up just too quickly, and ultimately that would end up hurting China's future. Go back to our expert here, Jim Rogers. So Jim, the local debt, it's a problem. You hate debt. But the debt is skyrocketing in China. What do we make out of this?
Well, Philip, debt is not bad if it's going into productive things. America, 100 years ago, was a big debtor. We spent money on railroads, factories, canals, schools, and we became the most successful country in the 20th century. If the debt is used properly, it's okay. Now, in America now, we're the biggest debtor in the world in history, but we're not borrowing money for good reasons. In China, to some extent, they're still borrowing money for good reasons. Yes, the debt is high. The debt has been going too high. And yes, there are going to be some problems in China. But I wouldn't give up on China if I were you. There are many countries that are in worse shape. But don't get me wrong. There will be problems in China. Every country which rises, every family, every industry, every company, every individual has setbacks along the way. China will certainly have setbacks.
Look, I mean, look, Jim, fair enough. Every family has their problems. Some fight it out, some get separated, and some end up ultimately get divorced and have a disaster. So there are different outcomes with the same problem. In China, how are they going to work their way out of these problems?
Some people are going to go bankrupt, Philip. It's not the end of the world. Look at America. In America in the 19th century, we had 15 depressions with a D, a horrible civil war, no human rights, massacres in the streets. And yet America became the most successful country in the 20th century. China will do the same sort of thing. I don't know what problems they'll have, but some people will go bankrupt, some people will disappear, but others will continue to rise in the end.
Very quickly, Jim. The government there is introducing new rules, trying to help the small investor in China. They make up a vast majority of the trading for stocks. Stocks have had an awful year, down 3 out of the last 4 years. Do we buy Chinese stocks right here?
Well, Philip, yes, I am buying some Chinese shares. The new conference in November said we're going to emphasize these areas. I'm buying small amounts so far of stocks in those areas. They said we have a terrible pollution problem. We're going to clean it up. Well, I'm not so smart, but I'm smart enough to buy pollution stocks in China. They said we're going to change the one-child policy. So I buy some baby stocks. If you look to see what they're doing, then you should do it too. It's very simple. But that doesn't mean the whole stock market is going to go higher, because there will be some problems. The real estate market in China is going to have problems. The government has said, we're going to do something about this bubble in property. So you've got to be careful. It's not everything. Just put your money where they're putting their money, Philip.
Jim, we love having you on the show. Jim Rogers joining us live from Singapore. We're going to keep you to it. We're going to look at these pollution and these baby stocks. In fact, email me with your stock picks, and we'll follow you throughout the year. Happy New Year to you, Jim, and to your family. Thank you.